Welcome to Commodity Wrap Kickoff, produced by Rural Radio, Channel 147. This morning's show is live, and we're taking your calls. If you have a question, call us now at 855-RR-ON-147. That's 855-776-6147 to reach our studio. Now, here's your host.
Morning. Welcome into Commodity Wrap Kickoff. I am Scott Shellady, otherwise known as the Cow Guy. Thank you very much for tuning us in here on Rural Radio, Sirius XM Channel 147. And just as the man said, give us a call or text. We can take text any day, but that's no fun. If you give us a call, we want to hear your voice. 855-776-6147. We're going to do the first segment with our next guest, Mr. Craig Bolanos. He's co-founder and wealth partner at VestGen Wealth Advisors up in Chicago. Craig, thanks for being on the show.
Hey, good morning and a very happy Friday to you. And it is fantastic with this market being so callous. We look right past Iran, Greenland, Venezuela. You know it. Market just keeps on rolling, Scott.
Yeah, well, I mean, we also have been able to survive a few economic data points as well. So we'll see what happens when they come out with Trump's tariffs. But if the market goes down, I think that's going to be an opportunity. I think he'll get his tariffs across, no matter what. There'll be a lot of people out there that get nervous and sell right away, but we'll see. But yeah, you know what? I'm just worried that everybody's on the same side of the boat here because it does look pretty good, right?
It's getting a little bit like we're priced to perfection. There's no doubt about it. I mean, listen, you had to raise your earnings targets for the S&P, but, at 21 to 22 times earnings, I start saying to myself, anytime we're trading above that 68.20 number, 68.20, and obviously we're pushing the 7K number, I think things are getting just a little bit stretched. And that doesn't mean people shouldn't be investing. It just means we need to give it some time for earnings growth to catch up to justify stock prices here. So everyone needs to stay long, but I think people really are going to need to be re-diversifying what's underneath the table in terms of their sectors and their security concentration, because the asymmetrical risk is definitely building as we go into the fourth year of this bull market rally.
Something that's been in the spotlight a lot lately, and I don't know really if it pertains to you as much, but it's housing and all the things that the president is trying to do to make it more affordable. Obviously, it's a midterm year, so he's going to be kind of extra sensitive to it. But he's put out some things like he's trying to buy some bonds to keep interest rates lower. They've talked about different kind of mortgages, 50-year and the likes. But there was something that this morning that Kevin Hassett, who's up for one of the people that could be replacing Jerome Powell, said that they've also floated this idea of using your 401k for the down payment. And the first question is, oh man, that might put people in a little bit of a bind towards the end of their lives. But no, that's not. It's going to be like a 401k swap, right? So if you took 50 grand out of your 401k for a down payment on your new home, whatever percentage of the value that was gets allocated back to your 401k. So now you have a real estate and stocks in your 401k. I thought that was pretty interesting.
It's interesting, but I just still believe at the end of the day it is a supply problem, and you're going to have to make some more availability. And I think the concept, even though I'm such a free market guy, maybe I'm really not, I think the concept of just striking large institutional ownership from continuing to buy up single-family dwellings, I think that's the move to make. I think all these other things that we've talked about, whether it's the credit cards, whether it's you just mentioned real estate and 401ks, this or that, I think all of those potentially run the risk of accelerating the asset price in housing, which is a whole large part of the problem too. I just don't like it.
Yeah, well, the more they get involved, the more things could go wrong. That's for sure.
That's correct, because you're right. I mean, let's just talk about that. When the government gets involved, the prices go up. I mean, what's everyone complain about? They complain about health care. Oh, the government's very much involved. People complain about the cost of education. Oh, the government's very much involved. I mean, I can go on and on and on. It's just a natural byproduct, and I don't know when we're going to start learning.
Well, I mean, ever since 2008, when they've actually gotten more and more involved with everything we've done, you see that the stock market's been a real beneficiary of that, right? I mean, it's been crazy if you look at a chart from 2008 going forward. But You're right. The government being involved has always been a hindrance, and it's always made things more expensive. And they may have the best intentions, but it never ever works out. And you're right. The first thing that comes to mind for me is actually education, even before health, because those education costs skyrocketed. Now I'm an old man, and I do remember what college cost when I was there, and it was still well within the realm of a kid to work 3 or 4 months over the summer and maybe something over Christmas to make a big dent in his or her tuition, and that's nowhere near possible now.
No, it's not. It is literally one of the avalanche issues in American financial planning. And Scott, I see it. I am in a blessed position that we were able to get my 23 and 24-year-old through college. But that means all of their friends, all of their peers, all these people I know intimately are literally drowning and dealing with the reality that they're graduating. And whether it was the student or the parents who didn't pay attention, these are the real numbers, Scott. Just in 2 weeks, had conversations with people who recognize now their payment stream that has started $1,100 to as high as $1,393 per month for people that I know. And how is a young person or parent supposed to launch in life or get retired when you got a 10-year amortization at $1,300 a month?
I mean, that's just it's a tragedy. And, I think you brought it to our attention on the show on the Cow Guy Close. One of the biggest impediments to buying a new house for anybody nowadays, or at least anybody under the age of probably 40, is that big student loan yoke they've got around their neck still. A lot of folks are still paying those off even into their late 30s, and that is one of the reasons why they can't get what they want to get.
Well, that is because, saving a down payment's one thing, but having your front end and your back end ratio, that's the calculation for payments versus income, they're completely jacked up because when you got an $1,100 to $1,300 a month student loan on top of your $400 to $600 a month car payment, and then you look at the average graduating salaries, there is no room. There is no room at all. And yes, they have to solve the college loan crisis. And unfortunately, a big part of it is what's already going into place, which is curbing the ability to borrow unlimited funds. So all the institutions who are cash drunk on spending government borrowing are going to slow down their expansions, their salaries, and their bureaucracy. And I'm hoping to continue to see more progress on that trend. But that pivot, that change is literally going to swallow up what I call a generation of college students who are kind of stuck in the middle. They're not on the left, they're not on the right, they're caught in the middle, and that's who's there right now.
Yeah, so you mentioned that you talk about that problem of getting over the hump of that monthly payment back for their student loans, and at the same time the asset prices skyrocketed. That just does not add up to anything worth anything. I mean, that's a really difficult spot.
No, it does, and it translates into something else that people don't like to talk about. We're not having enough babies in this country. We are not having enough babies in this country. That birth replacement ratio is way too low, and a big part of these societal trends where the formation of family units are coming together on these delayed starts or people are having less kids, it is honestly tied back to this because young people are responsible. There's never a good time to get married. There's never a good time to start families, but I understand how the delayed launches in life relative to what people perceive they were going to have is even having an impact on how young people are choosing to form long-term partnerships.
You're right. We got to do something about it. I'm just glad that I'm my age. That's all I'm saying. Got the Supreme Court trying to decide men and women's sports. I mean, you got to give me a break. Anyway, Craig, awesome to have you. Have a great weekend. Craig Bolanos, he's the co-founder and a wealth advisor at VestGen Wealth Partners up in Chicago. We're going to go away. We're going to pay some bills. We're going to come back and talk more right after this.
Friday nights on RFD TV. Gather around for a celebration of